What if I told you that $100,000 could grow without you adding a single dollar more? Imagine this. You put away that money today, and decades later, you're looking at $300,000 or more. No extra contributions, no complicated strategies, just time, patience, and the power of something most people completely underestimate. Here's the thing. We live in a world obsessed with quick wins and instant gratification. We want results now, not decades from now. But what if the secret to real wealth isn't about working harder or earning more? What if it's about understanding how money can literally work while you sleep? Most people look at their savings account and think, well, at least it's safe. But safe doesn't mean it's growing. Safe doesn't mean it's building your future. And here's what's shocking. The difference between money sitting idle and money working for you isn't just a few $1,000s. We're talking about hundreds of thousands of dollars over your lifetime. By the end of this video, you'll see exactly how this works. You'll understand why the wealthy get wealthier, and it's not just because they have more money to start with, it's because they understand something fundamental about how money multiplies over time. So let me ask you this. Have you ever wondered how much your savings could really grow if you left them alone and let them do their thing? Have you ever calculated what your money could become in 20 or 30 years? Most people haven't, and that's exactly why they miss out on life-changing wealth. Stick with me because what you're about to learn could completely transform your financial future. Let me introduce you to Sarah. She's 28 years old, works as a marketing professional, and after years of disciplined saving, she's managed to put away $100,000. That's no small feat, especially for someone her age juggling rent, student loans, and the cost of living in a competitive city. Now, Sarah's smart. She knows that leaving her money in a regular savings account earning less than 1% interest is basically letting it lose value to inflation. But here's her dilemma. She wants her money to grow, but she's afraid of risk. She's heard stories about market crashes, about people losing everything. So she's stuck in this middle ground, not sure what to do. This is where compound interest comes into the picture. And trust me, once you understand what I'm about to show you, you'll never look at your savings the same way again. Let's say Sarah decides to invest her $100,000 in a diversified portfolio that historically returns about 7% annually. Now, 7% might not sound like much at first, but here's where the magic happens. In year one, she earns $7,000. That takes her total to $107,000. In year two, she doesn't just earn another $7,000. She earns interest on that $107,000, which gives her about $7,400. Her total is now over $114,000. Fast forward 20 years, if Sarah never adds another dollar to that account, her $100,000 grows to approximately $387,000. Let that sink in. She nearly quadruples her money just by letting it sit and work for her. Now, I want you to imagine you're Sarah. You've got $100,000 sitting in your account right now. Would you invest it today, or would you wait? Would you let fear hold you back, or would you trust the numbers and let time do its thing? This is the first claim we're going to explore today. Compound interest is the engine that turns modest savings into substantial wealth. It's not magic, it's math, and it's available to anyone willing to be patient. Sarah's story isn't unique, it's actually quite common. What makes it powerful is understanding that she doesn't need to be a financial genius or take massive risks. She just needs to let her money work, reinvest the earnings, and give it time. All right, let's break down exactly how compound interest works, because understanding this concept is absolutely critical to building wealth. Here's the simple version. Compound interest means you're earning interest not just on your original investment, but also on all the interest that investment has already earned. It's interest on interest. And over time, this creates exponential growth that most people dramatically underestimate. Let me give you a basic example. Say you invest $1,000 at 7% annual return. After year one, you've earned $70, bringing your total to $1,070. In year two, you don't just earn another $70,
You earn 7% of $1,070, which is about $7,400. Now you're at $1,144.90. The difference seems small at first, right? But watch what happens over decades. That $1,000 becomes over $7,600 in 30 years. And here's the kicker. If you'd only earned simple interest, meaning just 7% of the original $1,000 each year, you'd only have $3,100. That's a difference of over $4,500 from the same initial investment. Now let's talk about something equally important: inflation. The stock market, specifically the S&P 500, has returned an average of 10.56% annually since 1957. That's the nominal return. But after adjusting for inflation, the real return is about 6.69%. This means your money isn't just growing in numbers, it's actually increasing in purchasing power, though more modestly than the headline number suggests. Here's the psychological reality check. Our brains are wired for linear thinking. We expect things to grow in straight lines, but compound growth is exponential. It curves upward, slowly at first, then dramatically. This is why so many people give up too early. They don't see massive gains in the first few years and assume it's not working. But patience is what separates wealth builders from everyone else. Do you think your savings could beat inflation over decades? If you're invested properly, the answer is absolutely yes. And that's not just optimistic thinking, that's historical fact backed by decades of market data. Here's something that might surprise you. The size of your starting investment dramatically affects your absolute gains, even though the percentage growth remains the same. Let me explain what I mean. If you invest $10,000 at 5% annual return, after 5 years, you'll have gained about $2,628. That's nice. But if you invest $100,000 at the same 5% return, you gain $26,280 in those same 5 years. Same percentage, but 10 times the absolute gain because your principal was 10 times larger. Now extend that timeline to 20 years. That $10,000 grows to about $265,330, a gain of $165,330. We're talking about a difference of nearly $150,000 in absolute gains, all from having a larger starting amount. This is the snowball effect in action. A bigger snowball picks up more snow as it rolls down the hill. A larger principal amount generates more interest, which then generates even more interest. It compounds faster in absolute terms, even though the percentage stays the same. Here's the psychological insight. Seeing large absolute numbers is incredibly motivating. When you watch your account grow by thousands or tens of thousands of dollars each year, it reinforces good behavior. It makes you want to keep going. It makes the sacrifice feel worth it. But here's a myth we need to bust right now. Some people think that because the percentage is the same, it doesn't matter whether you start with 5,000 or 50,000. That's technically true from a percentage perspective, but completely wrong from a wealth-building perspective. The absolute dollar gains are what actually change your life. 10% of 10,000 is $1,000. 10% of 100,000 is $10,000. Which one makes a bigger difference in your life? Let me ask you this. Which would you rather start with, 5,000 or 50,000? Obviously 50,000, right? But here's the real question. Are you doing everything you can to maximize that initial investment as early as possible? Are you prioritizing building that initial investment, or are you letting money slip through your fingers on things that don't matter? The bigger your starting principal, the bigger your wealth snowball becomes, and the earlier you start, the more time that snowball has to roll.
If there's one superpower in the world of wealth building, it's time. Not intelligence, not income. Time. Because time is the ultimate multiplier when it comes to compound growth. Let me introduce you to a powerful concept called the Rule of 72. This rule tells you approximately how long it takes for your investment to double based on your annual return. You simply divide 72 by your expected return rate. If you're earning 10% annually, your money doubles every 7.2 years. That means 100,000 becomes 200,000 in just over 7 years. $400,000 in 14 years, and $800,000 in about 21 years. Now here's where starting early becomes absolutely critical. Let's compare two scenarios. Scenario 1. You're 25 years old and you start investing $500 every month in an account that averages 10% returns. By the time you're 65, you'll have contributed $240,000 of your own money, but your account will be worth approximately $3.19 million. That's over $2.9 million in growth from compound interest alone. Scenario 2. You wait until you're 40 to start investing. Same $500 per month, same 10% return. By 65, you've contributed $150,000, but your account is worth only about $669,000. You contributed $90,000 less, but you ended up with over $2.5 million less in total wealth. That 15-year delay cost you millions. Let me repeat that. Delaying your investment by just 15 years can cost you millions of dollars in retirement wealth. This is the exponential cost of procrastination. Here's the psychological reality. We all think we have more time than we do. We tell ourselves we'll start investing next year, after we pay off this debt, after we get that promotion, after life settles down. But life never settles down. There's always something. And meanwhile, the clock is ticking, and you're losing the most valuable asset you have: time. If you could go back 10 years, would you invest earlier? Of course you would. So why are you still waiting now? Why not start today, even if it's just a small amount? Time doesn't care about your excuses. It doesn't wait for you to feel ready. It just keeps moving. And every day you delay is a day of compound growth you'll never get back. Let's talk about real evidence, not theory, not hope. Actual historical data that proves the power of long-term investing. The S&P 500, which tracks 500 of the largest publicly traded companies in America, has returned an average of 10.56% annually since 1957. That's the nominal return before adjusting for inflation. After inflation, the real return is about 6.69%. Either way, that's substantial growth over time. Here's what that means in practical terms. If you'd invested just $1 in the S&P 500 in 1957 and reinvested all dividends, that single dollar would have grown exponentially over the decades. We're not talking about doubling or tripling, we're talking about multiplying many times over. But let's be real for a second. This journey isn't smooth. The market doesn't go up in a straight line. There have been crashes, major crashes. We've seen the market drop 30% or more multiple times in history. The dot-com bubble, the 2008 financial crisis, the pandemic crash of 2020. These were terrifying times for investors. But here's what history teaches us. Every single time the market has crashed, it has recovered and gone on to reach new highs. Every single time. The investors who stayed the course, who didn't panic and sell at the bottom, were rewarded with long-term growth that far exceeded the short-term pain. This brings us to a crucial psychological insight: short-term pain versus long-term gain. Human beings are wired to avoid pain in the immediate moment. When we see our account balance drop by 20 or 30%, our instinct is to sell, to stop the bleeding. But that instinct, while natural, is exactly what destroys wealth. The investors who build real wealth are the ones who can stomach the volatility. They understand that crashes are temporary. They know that the long-term trend is upward. They have the patience and discipline to stay invested even when it's uncomfortable. So let me ask you this. Would you stay invested during a market crash? Would you have the emotional fortitude to watch your account value drop significantly and still not sell? Because your answer to that question determines whether you'll actually benefit from compound growth or whether you'll be one of the many who panic at the worst possible time. History doesn't lie. The data is clear. Long-term investing in diversified stock portfolios has been one of the most reliable wealth-building strategies for decades, but it requires something that's increasingly rare: patience. All right, enough theory. Let's talk about exactly what you need to do if you want to multiply $100,000, or any amount for that matter. Step 1.
Invest your money in a diversified portfolio. For most people, a low-cost S&P 500 index fund is the simplest and most effective option. You get instant diversification across 500 companies, minimal fees, and historical returns that speak for themselves. Step 2. Reinvest all dividends. This is critical. When companies pay dividends, you have a choice: take the cash or reinvest it into more shares. Always reinvest. Those dividends buy more shares, which generate more dividends, which buy even more shares. This is compounding in action. Step 3. Avoid early withdrawals at all costs. Every time you pull money out, you're not just losing that amount, you're losing all the future compound growth that money would have generated. A $5,000 withdrawal today could cost you tens of thousands of dollars in future wealth. Step 4. Stay consistent and monitor annually. Set up automatic contributions if possible. Don't check your account every day or every week. The more you look, the more likely you are to make emotional decisions. Check in once or twice a year, rebalance if necessary, and otherwise leave it alone. Here's a psychological hook that ties everything together. Small behaviors compound just like money. The discipline to invest automatically, the patience to not check your account constantly, the emotional control to not panic during downturns. These behaviors build on themselves. They become easier over time, and they're just as responsible for your wealth as the investment itself. So what's stopping you from making your first $100,000 investment, or your first $10,000, or your first $1,000? Whatever the amount, the principles are the same. Start now, stay consistent, reinvest everything, and give it time. Let's recap everything we've covered because these lessons are too important to forget. Compound interest is the engine that turns modest savings into substantial wealth. It's earning interest on your interest, and over time, it creates exponential growth that most people dramatically underestimate. A larger principal amount amplifies your absolute gains. The more you start with, the faster your wealth snowball grows. 10% of 100,000 is a lot more impactful than 10% of 10,000. Time is your ultimate superpower. Starting early, even with small amounts, beats starting late with large amounts. A 15-year delay can cost you millions in retirement wealth. Historical evidence proves that long-term investing works. The S&P 500 has delivered solid returns for decades, despite crashes and volatility. Patience rewards investors. Here's the hard truth. Knowledge without action equals missed opportunity. You can understand everything I've explained in this video and still end up broke if you don't actually do something about it. The difference between people who build wealth and people who don't isn't intelligence, it's action. So here's what I want you to do. Comment below and tell me, what's your target investment amount and how old are you right now? Are you starting early with the advantage of time, or are you playing catch-up? Let's build a community of people committed to making their money work for them. And if you found this video valuable, make sure to like and subscribe because in our next video, we're going to reveal a trick that could double small savings even faster. You won't want to miss it. Remember, $100,000 can become $387,000 in 20 years. $500 a month can become $3.19 million by retirement. These aren't fantasies. These are mathematical certainties for people who start now and stay consistent. Before we wrap up, I want to give you some bonus strategies that can supercharge your compound growth even further. First, take full advantage of tax-advantaged accounts like 401ks and IRAs. These accounts allow your investments to grow tax-deferred or even tax-free. That means more of your money stays invested and compounds instead of going to taxes. If your employer offers a 401k match, that's literally free money. Contribute at least enough to get the full match. It's an instant 100% return on that portion of your investment. Second, use dollar cost averaging. This means investing a fixed amount of money at regular intervals, regardless of market conditions. When the market is down, your fixed amount buys more shares. When it's up, you buy fewer shares. Over time, this strategy reduces the impact of market volatility and takes the emotion out of investing. You're not trying to time the market. You're systematically building wealth. Third, implement dividend reinvestment strategies. We touched on this earlier, but it's worth emphasizing again. Dividends are powerful because they provide regular income that can be reinvested to buy more shares. Over decades, dividend reinvestment can account for a huge portion of your total returns. Don't underestimate it.
Here's a psychological hook that ties everything together. Even modest adjustments to your investment strategy can accelerate your wealth faster than adding new money. Think about that. Optimizing how you invest, choosing the right accounts, reinvesting dividends. These tweaks can have a bigger impact than just throwing more cash at the problem. This is why financial education is so valuable. It's not about earning more, although that helps. It's about making smarter decisions with the money you already have. Now, I want you to do something important. Share this video with friends or family members who are planning for retirement or just starting their investment journey. The information in this video could genuinely change someone's financial future, and the more people understand these principles, the better off we all are. Finally, remember this. Wealth building isn't about get-rich-quick schemes or gambling on the latest hot stock. It's about understanding fundamental principles, staying disciplined, and letting time do the heavy lifting. You now know how $100,000 can become $387,000. You know how $500 a month can become over $3 million. You've seen the evidence. You've heard the strategies. The only question left is, what are you going to do about it? Thanks for watching. Hit that subscribe button, drop a comment with your investment goals, and I'll see you in the next video where we'll dive even deeper into strategies that can accelerate your wealth building journey. Until then, make your money work for you.